Good day, everyone. Our topic for today is about the users of financial information. Financial information is more than just numbers, it's a powerful tool that guides decisions, builds trust, and shapes the future of organizations. Every report, statement, and forecast serves a purpose for someone, whether inside the company or beyond its walls. From managers planning strategies to investors weighing risks, each user interprets financial data through their unique lens. Understanding who these users are and what they need helps us appreciate the real-world impact of accounting. In this lesson, we'll explore how financial information connects people, decisions, and values across every corner of the business world. Here are the learning objectives for this topic. 1. To understand the roles and needs of various internal and external users of financial information. Understanding the diverse users of financial information reveals how accounting serves as a bridge between data and decision-making. Each user, whether a manager, investor, or government agency, relies on financial insights to fulfill specific goals and responsibilities. Recognizing these roles helps students appreciate accounting as a dynamic and purpose-driven discipline. 2. To remember key characteristics and examples of financial information users. Remembering who uses financial information and why strengthens students' ability to connect theory to practice. By identifying examples like employees seeking job security or creditors assessing risk, learners build a mental map of how financial data flows through real-world scenarios. This recall supports deeper engagement and prepares students for applied learning. 3. To analyze how different users interpret and apply financial data in decision-making contexts. Analyzing how users interpret financial data encourages critical thinking and empathy. Students learn that the same report can lead to different decisions depending on the user's perspective, priorities, and context. This analytical lens transforms accounting from a static subject into a tool for insight, strategy, and ethical leadership. What are the types of users of financial information? 1. Internal users. Internal users are individuals within the organization who use financial information to guide decisions, manage operations, and evaluate performance. Managers, employees, owners, department heads, and internal auditors rely on data such as budgets, forecasts, and financial statements to plan strategically and monitor results. Their access to detailed and often confidential financial records allows them to make informed choices that directly affect the organization's direction. Understanding internal users helps students see how accounting supports day-to-day leadership and operational control. By analyzing their needs, learners recognize how financial data becomes a tool for growth, accountability, and organizational success. 2. External users. External users are individuals or entities outside the organization who depend on financial information to make decisions about investment, regulation, credit, and public trust. These include investors, creditors, government agencies, customers, and the general public, each with distinct interests and expectations. Unlike internal users, they rely on publicly available reports such as financial statements to assess performance, stability, and ethical conduct. Understanding external users helps students appreciate the broader impact of accounting on society, markets, and governance. By analyzing how these users interpret financial data, learners gain insight into the importance of transparency, accuracy, and responsible reporting. Who are the internal users? 1. Managers. Strategic decision-making is at the heart of a manager's role, and financial information provides the foundation for those choices. Whether deciding to expand operations, cut costs, or invest in new projects, managers use financial data to weigh risks and benefits. Resource allocation becomes more effective when guided by accurate financial insights. Monitoring performance through financial metrics ensures that goals are being met and inefficiencies are addressed. Understanding this dynamic helps students see accounting as a strategic tool, not just a record-keeping function. Budgets and forecasts allow managers to plan ahead and set realistic targets for their teams. Financial statements, such as income statements and balance sheets, provide snapshots of current performance and profitability. These tools help managers identify trends, anticipate challenges, and adjust strategies accordingly. By remembering the importance of these documents, students can appreciate how accounting supports day-to-day operations. Analyzing how managers use these tools reveals the connection between financial planning and operational success. Managers depend on accounting to plan effectively and maintain control over organizational activities. Planning involves setting financial goals, while control ensures that actual performance aligns with those goals. Accounting provides the data needed to compare expectations with outcomes, enabling timely interventions. When students understand these needs, they begin to see accounting as a proactive discipline that drives organizational efficiency. This insight encourages learners to think critically about how financial systems support leadership. Managers are not just concerned with past performance, they focus on shaping the future. Predictive data, such as forecasts and trend analyses, helps them anticipate market shifts and prepare for uncertainties. This forward-looking mindset requires financial tools that offer more than historical records. Remembering this helps students distinguish between reactive and proactive uses of accounting. Analyzing predictive data use shows how financial information becomes a strategic compass for decision makers. Every major decision a manager makes, from launching a new product to restructuring a department, is influenced by financial insights. These decisions determine the trajectory of the organization and its ability to compete and grow. By analyzing how managers interpret financial data, students gain a deeper understanding of the relationship between numbers and strategy. This analysis also highlights the importance of accuracy and timeliness in financial reporting. Ultimately, it shows how accounting serves as a blueprint for organizational success. 2. Employees. Employees often look at financial performance to gauge whether their jobs are secure and whether salary increases are feasible. A company with strong profits and stable cash flow signals a healthy environment for career growth. Understanding this connection helps students see how accounting affects everyday workplace realities. Remembering that employees are stakeholders reinforces their role in the financial ecosystem. Analyzing this perspective reveals how financial data influences morale and retention. Employees track company stability through indicators like net income, debt levels, and operational efficiency. These metrics help them understand whether the business can sustain itself and grow. When students grasp this, they begin to see accounting as a tool for organizational health. Remembering that profitability affects not just owners but employees too deepens their appreciation of financial transparency. Analyzing these metrics shows how internal users rely on accounting for long-term confidence. A financially healthy company is more likely to offer promotions, training, and career advancement. Employees may use financial reports to assess whether the organization is investing in growth. Understanding this helps students connect accounting to human resource development. Remembering that future opportunities are tied to financial performance reinforces the importance of accurate reporting. Analyzing this link reveals how accounting supports employee engagement and planning. Employees are directly impacted by the success or failure of the business. Their livelihoods depend on the company's ability to generate revenue and manage costs. Understanding this stakeholder relationship helps students see accounting as a shared concern. Remembering that employees are part of the financial narrative fosters empathy and responsibility. Analyzing performance outcomes shows how accounting data reflects real-world consequences. Financial outcomes influence not just company metrics but the lives of its employees. Job satisfaction, benefits, and career stability are all tied to financial performance. Understanding this connection helps students see accounting as a human-centered discipline. Remembering the personal impact of financial data encourages ethical and transparent practices. Analyzing this link reveals how accounting supports well-being and workplace culture. Planning. 3. Owners. Owners rely on financial reports to determine whether their investment is profitable and sustainable. They examine income statements and equity changes to assess business health. Understanding this helps students connect accounting to entrepreneurial decision-making. Remembering that owners use these reports for strategic planning reinforces the importance of accuracy. Analyzing these evaluations shows how accounting supports long-term vision and accountability. Net income and equity are key indicators of a company's financial success. Owners use these figures to measure growth and determine reinvestment strategies. Understanding this focus helps students appreciate the core metrics of financial performance. Remembering the importance of these indicators reinforces their role in ownership decisions. Analyzing these metrics reveals how accounting reflects value creation. Owners use financial data to decide whether to expand, pivot, or exit a business. These decisions shape the future of the company and its market position. Understanding this strategic use of accounting helps students see its role in leadership. Remembering that financial data guides investment choices emphasizes its practical value. Analyzing these decisions shows how accounting informs risk and opportunity. Owners are the ones who absorb losses and reap profits, making financial accuracy critical. Their exposure to risk means they depend heavily on reliable data. Understanding this helps students appreciate the stakes involved in business ownership. Remembering the dual nature of risk and reward reinforces the ethical responsibility of accountants. Analyzing this dynamic shows how accounting supports informed risk management. Owners need precise financial information to hold managers and departments accountable. Inaccurate data can lead to poor decisions and financial loss. Understanding this need for accountability helps students see accounting as a governance tool. Remembering the importance of accuracy reinforces professional standards. Analyzing this requirement shows how accounting supports transparency and trust. 4. Internal auditors. Internal auditors verify that financial records are correct and comply with regulations. Their work prevents fraud and ensures ethical practices. Understanding this role helps students see accounting as a safeguard. Remembering the importance of compliance reinforces the value of integrity. Analyzing audit processes shows how accounting protects organizational credibility. Auditors help protect company assets by identifying weaknesses in financial systems. They recommend improvements to internal controls that reduce risk. Understanding this function helps students connect accounting to operational security. Remembering that auditors prevent loss reinforces their strategic importance. Analyzing their work reveals how accounting supports efficiency and protection. Internal auditors uphold ethical standards by ensuring transparency and fairness in reporting. They also identify inefficiencies that can be corrected for better performance. Understanding this dual role helps students see accounting as both moral and practical. Remembering the ethical dimension reinforces responsible behavior. Analyzing audit findings shows how accounting drives improvement. Auditors monitor financial activities to detect irregularities and enforce policies. Their presence encourages accountability across departments. Understanding this watchdog role helps students appreciate internal checks and balances. Remembering their oversight function reinforces the importance of internal review. Analyzing their impact shows how accounting supports governance. Through audits, internal auditors uncover what's working and what needs improvement. Their insights guide management in refining processes and strategies. Understanding this evaluative role helps students see accounting as diagnostic. Remembering that audits reveal patterns reinforces the value of analysis. Analyzing audit results shows how accounting informs continuous improvement. Who are the external users? 1. Investors. Investors use financial data to assess whether a company is worth their money. They look for signs of profitability and sustainable growth. Understanding this helps students connect accounting to investment strategy. Remembering that investors seek both returns and stability reinforces the need for clear reporting. Analyzing investor behavior shows how accounting influences financial markets. Key metrics like earnings per share and dividend yield guide investor decisions. Financial ratios help them compare performance across companies. Understanding these tools helps students appreciate the analytical side of accounting. Remembering their importance reinforces the need for precision. Analyzing these metrics shows how accounting supports comparative evaluation. Investors rely on income statements, balance sheets, and cash flow reports to make informed choices. These documents reveal a company's financial health and future prospects. Understanding this reliance helps students see accounting as a decision-making resource. Remembering the role of statements reinforces their foundational importance. Analyzing their use shows how accounting supports strategic investment. Investors need honest and clear financial information to trust a company. Misleading reports can result in financial loss and damage reputations. Understanding this need for transparency helps students value ethical accounting. Remembering the consequences of dishonesty reinforces professional responsibility. Analyzing investor trust shows how accounting builds credibility. Investor decisions affect stock prices, funding availability, and market trends. Their reactions to financial data can shift entire industries. Understanding this influence helps students connect accounting to economic systems. Remembering the ripple effect reinforces the importance of accuracy. Analyzing investor impact shows how accounting shapes financial ecosystems. 2. Creditors. Creditors use financial reports to determine whether a company can meet its debt obligations. They examine income statements and cash flow to assess repayment capacity. Understanding this helps students connect accounting to financial trust and lending decisions. Remembering that repayment ability affects loan approval reinforces the importance of liquidity. Analyzing creditor evaluations shows how accounting supports responsible borrowing. Liquidity ratios reveal a company's ability to pay short-term debts, while solvency ratios assess long-term financial stability. Cash flow statements show whether the company generates enough cash to cover obligations. Understanding these metrics helps students appreciate the depth of financial analysis. Remembering their role in credit decisions reinforces the need for comprehensive reporting. Analyzing these indicators shows how accounting informs financial risk management. Creditors assess creditworthiness by analyzing financial history, debt levels, and repayment patterns. High risk may lead to higher interest rates or loan denial. Understanding this evaluation process helps students see accounting as a gatekeeper for financial access. Remembering that risk assessment affects business growth reinforces the importance of financial discipline. Analyzing credit decisions shows how accounting influences financial relationships. The financial data provided by a company directly affects the terms of its loans, such as interest rates, repayment schedules, and collateral requirements. Creditors use this information to tailor agreements that reflect the company's financial health. Understanding this influence helps students connect accounting to negotiation and finance. Remembering that lending terms are data-driven reinforces the need for accuracy. Analyzing these outcomes shows how accounting shapes financial contracts. Creditors prefer working with companies that demonstrate consistent financial performance. Stability reduces the risk of default and builds long-term trust. Understanding this preference helps students see accounting as a foundation for credibility. Remembering that reliability attracts better financial opportunities reinforces ethical reporting. Analyzing creditor expectations shows how accounting supports sustainable business relationships. 3. Government agencies. Government agencies use financial reports to ensure businesses comply with tax laws and regulations. Accurate reporting helps prevent fraud and ensures fair contribution to public funds. Understanding this oversight helps students connect accounting to civic responsibility. Remembering the role of compliance reinforces the importance of legal accuracy. Analyzing government audits shows how accounting supports public trust. Governments analyze financial data to understand industry trends and economic health. This information informs policy decisions, subsidies, and regulatory changes. Understanding this use of accounting helps students see its impact beyond the business world. Remembering that financial data shapes national strategies reinforces its societal value. Analyzing policy outcomes shows how accounting influences governance. Financial reports help government agencies detect unethical or illegal practices such as tax evasion or misrepresentation. They enforce standards that promote fairness and protect consumers. Understanding this legal role helps students appreciate accounting as a tool for justice. Remembering the consequences of non-compliance reinforces ethical behavior. Analyzing enforcement actions shows how accounting supports accountability. Governments require businesses to disclose financial information to ensure transparency. This openness builds public confidence and deters misconduct. Understanding this requirement helps students value honesty in financial reporting. Remembering that transparency is a public expectation reinforces professional integrity. Analyzing disclosure practices shows how accounting supports democratic values. When businesses report financial data accurately, they contribute to public trust in the economy. This trust influences regulatory frameworks and investor confidence. Understanding this relationship helps students connect accounting to social stability. Remembering that trust is earned through transparency reinforces ethical standards. Analyzing public reactions shows how accounting shapes reputation and policy. 4. Customers. Customers may review financial data to determine whether a company can fulfill long-term commitments. Stability signals that the business is dependable and trustworthy. Understanding this helps students connect accounting to customer relationships. Remembering that reliability affects purchasing decisions reinforces the importance of financial health. Analyzing customer behavior shows how accounting supports brand confidence. In B2B settings, customers often choose suppliers based on financial strength and sustainability. A company with solid financials is more likely to deliver consistent service. Understanding this helps students see accounting as a factor in strategic partnerships. Remembering that financial data influences trust reinforces its practical value. Analyzing partnership decisions shows how accounting supports collaboration. Customers associate financial transparency with honesty and reliability. A company that shares its financial status openly earns greater trust. Understanding this perception helps students value ethical communication. Remembering that trust is built through openness reinforces responsible reporting. Analyzing customer expectations shows how accounting supports relationship building. Customers are more likely to support companies that are transparent about their finances and values. Reputation is shaped by how openly a business communicates its performance. Understanding this influence helps students connect accounting to marketing and public relations. Remembering that reputation affects sales reinforces the importance of clear reporting. Analyzing brand loyalty shows how accounting supports consumer engagement. Customers may interpret strong financial performance as a sign of quality and reliability in products or services. Financial health suggests that the company can invest in innovation and support. Understanding this link helps students see accounting as part of customer experience. Remembering that financial outcomes affect perception reinforces the need for consistency. Analyzing customer confidence shows how accounting supports competitive advantage. 5. General public. The general public uses financial reports to evaluate how companies affect communities and the environment. These insights shape opinions about corporate responsibility. Understanding this broader view helps students connect accounting to social impact. Remembering that financial data reflects values reinforces ethical awareness. Analyzing public scrutiny shows how accounting supports transparency. People look for financial disclosures related to environmental efforts, fair labor, and ethical sourcing. These reports influence public support and activism. Understanding this monitoring helps students see accounting as a tool for advocacy. Remembering that ethics are reflected in numbers reinforces responsible reporting. Analyzing sustainability metrics shows how accounting supports long-term stewardship. Transparent financial reporting fosters trust between companies and the communities they serve. It shows that businesses are willing to be held accountable. Understanding this trust building helps students value openness in accounting. Remembering that transparency affects reputation reinforces professional standards. Analyzing public trust shows how accounting supports civic engagement. Financial data can spark conversations about inequality, corporate influence, and economic justice. The public uses this information to advocate for change and hold companies accountable. Understanding this discourse helps students see accounting as part of democratic participation. Remembering that financial reports are public documents reinforces their societal role. Analyzing civic reactions shows how accounting supports informed debate. A company's financial behavior influences how it is perceived by the public. Responsible reporting and ethical practices enhance reputation and attract support. Understanding this influence helps students connect accounting to branding and values. Remembering that reputation is built on actions reinforces the importance of integrity. Analyzing public perception shows how accounting supports ethical leadership. Financial information is more than numbers, it's a language of trust, strategy, and accountability. Each user interprets this language through their unique lens, shaping decisions that ripple across organizations and society. As students reflect on these roles, they begin to see accounting not just as a technical skill, but as a tool for empowerment, insight, and ethical leadership. By understanding, remembering, and analyzing these perspectives, learners become more thoughtful stewards of financial knowledge, ready to connect data with purpose.